Home Depot posting a beat, and management says inflation has abated. That stock surging 6% today. Does it bode well for the rest of retail earnings season? Let's look ahead to Target, JD.com, and TJX. In today's earnings exchange, here with our trades is Gina Sanchez, Lido Advisors chief market strategist and a CNBC contributor. Good to see you, Gina. Let's start with Target. Shares down 25% this year. It's been a tough stretch. They revised guidance lower amid disappointing sales last quarter. CEO warned about continued near-term top-line challenges. Analysts are also concerned about demand and the continuing theft problem, which the company blamed for those 9 recent store closures. Stocks up 4% today, though. Is it turning a corner? Are you a buyer here?
Well, so this is a tough one because you're right. The outlook for Target is not great. They are not projecting great numbers, and they have had trouble with traffic into stores and just top-line revenue. However, the kind of finally seeing some relief in inflation and seeing some relief in the supply chain has allowed them to finally build up profitability. So you've actually seen operating margins finally starting to expand. So the company itself is becoming more and more profitable, despite the fact that it's fighting these pretty tough headwinds. The one thing about it is very cheap right now. It is very attractive relative to the rest of the beaten down sector. So, you know, if you're legging into this, it is on valuation.
Now, actually, I don't know if we can show the price to earnings multiple. Do you know it off the top of your head?
Yeah, it's down about 9.
Wow, is it? Single digits. Okay.
Yeah.
So Target, again, you say this would be a valuation buy, really a value trade almost more than anything. Still down about 14% the past 3 months. Yeah, we're giving it about a 13, but again, it kind of depends on what estimates you're using. Let's move along let's go to JD.com. Those shares are down also 50% this year. The recovery in China, huge headwind, continues to disappoint. Mizuho warns that their revenues could be pressured as they undergo a price matching and inventory revamp, but more promotions are expected to entice some buyers back. So we've got a Chinese story, retail story here stuck in the middle of the rest of earnings season, Gina. And who would want us to put their necks out here, do you think?
So here you have to believe that China itself is turning a corner. And, you know, GDP has obviously been really shaky. There are, you know, you can make a strong argument that we're starting to see some stabilization in the GDP numbers, and you're starting to see some support in actual retail sales in China, and possibly some green shoots in the property sector, which is really the kind of area of China that still represents the greatest risk. And so if you believe all that, then you have to believe that the long-awaited China reopening and consumption story should start to play out. Now, the outlook for JD from JD themselves is still not very positive yet. And so really you're listening to hear what that outlook is at the e-commerce company level.
Yeah.
Right now, if you believe that you're legging into a China reopening, this is a play that should work.
Amazing to see the shares are only up 40% since their IPO 9 years ago. Quick question on this one and kind of on all of them, Gina. Do you think the Shein, Temu, the rise of those apps, is that having an impact?
Well, I think right now a lot of things are having a lot of impact. You're saying in the Chinese market specifically? Or just broadly?
Okay. I was saying just broadly speaking. Do you know, are they having an impact in China as well? It's pretty obvious they're having an impact here.
Yeah, it's hard to say right now. Right now, what's driving the market really isn't competition. What's driving the market is just simply purse tightening across the consumer sector and the retail sector. All
right, which brings us to TJX, owner of TJ Maxx Home Goods. They're back near their September all-time high. This one has been the real outperformer of the group. Huge market cap, too. We're talking about $100 billion. That's thanks in part to its lower prices. According to Citi, perhaps it's also in part to winning some share from bankrupt Bed Bath & Beyond, as they have experienced accelerating traffic at Home Goods in particular. Is this kind of who was it, Mike Mayo, the Goliath, stick with Goliath, winner take all kind of thing? You stick with Goliath in the retail space here?
You know, so this one is expensive but worth it. Look, this is a store that everybody loves. When times are tough, people like value. And that's the difference between TJX and Target. Is that at TJX, you're going into TJ Maxx, you're going into Marshalls, and Home Goods, you're absolutely spot on that they are taking market share from Bed Bath & Beyond. The traffic numbers on all of these stores has been very positive and expected to continue to be positive, despite the fact that the overall outlook for consumption over the next quarter is still expected to continue to decline. This is a company that continues to get more than its fair share of traffic, and the valuation reflects it. I mean, it's over 30 times forward earnings. So this is one that you're paying for. However, the outlook is still bright. It's still expected to have positive growth next year.
All right,
that's a big deal.